Okay, welcome back to Self-Managed 360. Now we'll talk, before we go straight into our investment strategy, uh, what are the alternatives to stock market investing? Obviously, there's a few options here, and they are relevant, I think, but an investor should first sit back and look at his or her situation. Each type of investor will be different. We have to first, if we have some money that we want to invest, we need to be honest with yourself and say, well, do you need that money short term? So in the next 1 year, 2 years, 3 years, you have some money you want to invest. Are you planning to use it for projects such as you may want to purchase a house? You need to send your your kids to school, so you need to pay for the education of your kids, or you may be entering retirement, or you may be retired already. So obviously, we need to be honest that stock markets are risky. Risky being that obviously, if you invest in good companies, stock markets will, on the long term, will not be risky. However, short term, something may happen that's going to crash the stock market. So you don't want to see if you have to invest $10,000, you want to make sure to have it in a year and a half, 2 years to pay for education of your school of your kids, or if you want to purchase a house. You don't want to invest that money in the stock markets because you want to make sure that the capital, the $15,000 you want to invest, it must be protected, and you should invest it in safer investment vehicles. Safe investment vehicles can be bonds, as we see on the slide here. Uh, Bonds obviously can be risky if you decide to purchase government bonds from a country that is in financial trouble. You may not want to invest on bonds issued by Kazakhstan, or maybe not Kazakhstan, but any type of countries that may have a history of not paying back its investors. But if you invest in government bonds from the United States or from solid European countries, from Canada, you should expect your investment to be safe. So it will be paid back, plus you will get a premium or an interest paid on it. When you look at it, the interest rates on bonds is not very high, at least in 2017. You can expect maybe 1 to 2%, maybe 4% if you're lucky, which is not that much compared to what could be obtained from the stock markets long term. However, bonds can be interesting for investors that are closing in on their retirements, or like we've said, that may have a project that will have to be financed, and you don't want to risk your money into the stock markets if you need that money short term. You can also decide to invest in real estate. I think real estate is interesting. It can generate revenues. It's probably not as risky as the stock markets. Uh, Real estate need to be seen as capital intensive. You need to have quite a lot of money up front to be able to acquire revenue generating properties, and can be also time consuming. Uh, it's also you have to understand how you're going to pay tax every year. You have to pay tax on the revenues that will be generated. So this is something that needs to be understood before you jump into real estate investing. Um, Stock market investing are nice ways to grow your wealth, but we need to understand that in terms of investing options, opportunities, they can be seen as high risk, so they're volatile. This is probably Volatility can be a friend or also an enemy short term. Even if you invest on good companies, as we've said, they can be risky to invest in stock markets to protect your capital on the short term. If we enter into a bear market, for example, you may see even the best companies have your stock price reduced, sometimes greatly, only to bounce back if at the end of the day the fundamentals are going to justify the fair market price. Some companies on the stock markets are not going to survive. As we've said, we're going to look at companies that are profitable, but some companies are trading, lots of companies are trading, they're not yet making a profit, and you don't want to get involved in the stock markets, but error is of human nature. Sometimes we are not going to pick the right companies to invest in, so there's a risk to it. It's not always easy to understand how to invest decently in the stock markets compared to just purchasing a government bond. Good thing about stock markets, owning stock is easy once you've completed the purchase of a chunk of shares of a company. You just have to sit back and see how it goes. You can also build a portfolio with $100. Obviously, I wish that we can have more, but getting involved in the stock markets will not require much money compared to, for example, real estate. I think what we need to look at is two great advantages of stock market investing. Long term is going to give you a better investment performance than other types of alternatives or of options if you invest in good companies. And it's also liquid. It's normally, unless you bought shares of a company that is actually going to go bankrupt, you may have some trouble finding somebody that wants to buy the shares from you. But if you buy some solid companies, and for whatever reasons you need that money to finance a project, it's easy to sell. You can convert your shares back to money within normally 24 hours. That's not the case of government bonds that are sometimes stuck in the investing vehicle for a year or 2 years or 3 years. So, stock markets investing, if we look at the major stock market indexes in the USA, as we've said in the previous videos, we're going to concentrate on American and Canadian markets, and US markets is king for us. The Dow Jones Index has given an average yearly return of about 9%. Depending on where you go, you may see 8%. Some people will consider dividends or not in this calculation, but it gives you 8-9% per year average. Obviously, this is the good years and bad years combined. But if you decide to purchase the Dow Jones Index and you keep it for the long term, you'll have very good years, some average years, some bad years, some very bad years. But you should expect to make plus minus 8, 9, 10% per year, which is a lot better than government bonds. The SP 500 is giving an even better yearly average or return on your investment. The Nasdaq is also giving a pretty decent return on your investment. Again, this is long term. This is an average per year that's spread on 50, 60 years. So you may have some bad years and some very good years. So again, if you are an investor that is entering retirement, or if you are not necessarily prone to risk, or you don't know how to manage it, or you become emotional, you may want to invest some of your money on safer alternatives such as government bonds or even real estate. So, how can you, if we keep our discussion on stock market investing ongoing here, let's say that you want to get involved in the stock market. So you'll decide on the percentage of your investment portfolio that you want to invest in stock markets. How can you get involved in the stock markets? Well, first you can actually hire a company that will manage your investment for you. So it's obviously easier. They will pick companies for you. They will use their expertise. They often manage investment from a lot of investors, millions of dollars of investment, so they have their own advisors. They will build your portfolio, and they will try to give you the best return they can. They will obviously charge you a percentage, a fee that will often be calculated. It's going to be a percentage on the amount of money they're managing. So as your portfolio grows, the fee will grow as well. You can also decide to do it on yourself, and you can buy funds that are trading on the stock markets that are made of a bunch of companies that at the end of the day will track the major stock index. So you can buy a fund that's tracking the S&P 500 index. So if the S&P 500 index is generating a 10% increase in 1 year, well, you should expect to see the fund you bought to gain about 10% during that year. You can buy also the Dow Jones Index. So that's going to facilitate your job if you don't want to get involved in analyzing, evaluating stocks specifically. You just have to buy the funds, and then you're actually invested in the stock markets, and you will basically obtain the same performance on your investment that the average stock market will do during a year, during 5 years, and so on. Then what we decide to do here at Self-Managed 360 is to actually manage ourselves, our portfolio, using an online trading account. So it's going to help you reduce your management fees, so you're not going to have to pay somebody to do it for you. You will pay for each transaction. So normally when you have a trading account online, you're going to pay a fee when you buy shares. Even if you buy 5 or 50 shares, you're going to pay the same fee. And you're going to pay a fee when you decide to sell your shares. Every transaction you make, you're going to be paying a fee. And that, depending on the institutions, the financial institution you will use, fees can be different, but it can vary between $10 and $20. So try to find the best option for you. Obviously, we can try to obtain, if we decide to invest our time in managing yourself a portfolio and picking the companies we want to invest in, our goal will be to beat the indexes, do better than the indexes. Because if we can't do that, the amount of time that we will invest in our strategy, well, why not just purchase, as we've said here, to buy funds that are tracking the indexes, so we'll save a lot of time and we will do as good as the overall markets will do. Our goal here, to manage our portfolio ourselves, will be to do better, try to do better than the indexes. It will require some effort. Obviously, we'll have to build a portfolio, so we'll have to select stocks we want to invest in. And as we will see in the following videos, we'll look at the different types of fundamentals, key statistics, values that we will use in order to evaluate companies, and then we'll make our choice on which one to invest so that we can build our portfolio. And this is the next steps and next videos will discuss exactly this.